What's up, investors? Today we're going to be taking a deep dive into the largest cash machine on the stock market that owns the world's communication. So of course it's Facebook, but now it's actually going to be called Meta, and it'll change its ticker symbol on December 1st, which I'll go into a little bit later on. But it was pretty funny. I saw this joke on Reddit. This one guy was like, well, Facebook's the biggest joke and now they're a meta joke. It was pretty funny, it cracked me up. Alright guys, so let's start with their Q3 results that just came out a few days ago. Starting with those, then I'll go over the risks with you guys, the ones that you guys should be aware about, and why particularly now. Talking about some very basic resistance and moving averages that you guys should always take a look at before buying, and the ones that I use myself. So starting with their Q3 results, guys, they're growing their revenues at 33% still, even though they've been around for so long, which is amazing. And this is why I love Facebook, because they're a growth company, but it's also a value play here, because of the recent pullback it's had, but that's for later. So their operating margin is still relatively consistent. Their net income also grew by 17%. Their daily active users also grew by 6% to 1.93, and their monthly active users grew to 2.91 billion, which is what we want to see. They also did $14 billion in share repurchases in the third quarter, and actually announced a $50 billion increase to the share repurchase authorization today. So if you guys don't know, companies will do their buybacks for a number of reasons. They'll do it if they want to increase their equity value, which is shown on the balance sheet. So this is when the company will want to buy back their own shares at the market value. And a lot of companies will do this if they genuinely feel that their shares are undervalued. And doing this is also a very easy way to make the financial statements look better and more attractive to investors, since the earnings per share ratio increases as the number of outstanding shares are now being reduced and the annual earnings are usually increasing. So now taking a look at their balance sheet, guys, they currently have $75 billion in current assets, which is mostly just cash and securities, which are very liquid. So their total assets increased by about 10 billion, and looking at their total liabilities, they went from 31 billion to 36. So they increased their liabilities by 5 billion, but they increased their total assets by 10 billion. So there's no issue there. With their current liabilities sitting at around 17 billion, they can pay off their current liabilities 4 times over and still have cash left over. So their cash position is just awesome. And now one last thing I want to show you guys here on page 9. If we go to their cash flow statement, their cash flow is right here at the bottom. Their free cash flow is sitting at $9.5 billion, which is a 60% increase from roughly 6 billion. And I don't even know what to say about that. Like, of course, this is just for the 3 months, but still, that's just great. Like, free cash flow is one of the most important things that everyone should look at, because this is the cash that's left over after paying all of its operations and capital expenditures. So the more free cash flow a company actually has, the better it's placed to pay down debt, pursue other opportunities that it can actually enhance its business, and that can make it a more attractive choice for investors. So considering that it actually makes almost 10 billion in excess cash in 3 months, they're going to be investing about 10 billion into their Realty Labs segment, and this is one of the reasons why Facebook's share price might have taken a dip as well. So you guys can find this information on the second page, but I do all the reading for you guys so you guys don't have to, and that's the whole point. And I show you guys all the information instead of just showing you my face only, because then you don't really have to fact check me. But I mean, still do your own DD. But anyways, guys, if you're liking the content so far, please go and smash that subscribe and like button to help me out. So in here, they're saying that they're going to be spending a significant amount towards augmented reality and virtual reality, which they call the next generation of online social experiences. Personally, guys, I don't really have an issue with this. I'm very forward looking, and considering they're making $10 billion a quarter in excess cash, big investments will eventually pay off in the future. But the only risk is that, for example, consider how TVs were made. They were first black and white, and then years later, when the adoption actually happened, you got the color TV, and then the 720p, and then HD, and then 4K. So it took years for that to happen. And it's same with virtual reality. Like, that's just barely starting to take off, and that's definitely way ahead of augmented reality. So virtual reality is when everything we see and hear is computer generated. So this can be like a headset we put on. And augmented reality is when you look at the real world, but it's augmented with additional information or graphics in your way. So you can be wearing glasses, and when someone calls you, it'll show up like a person calling. Or even when you use your phone and play Pokemon Go or go on some Snapchat filters, that show like creatures in front of you when you use them. So they're investing a lot here, but this most likely won't be a big contributor to their net income for many years to come. So now let's discuss the bear side and all the negative stuff that they have going on. Number one, guys, you already know it. Facebook generally has a very bad track record when it comes to privacy and the bigger picture of like social impact that platforms have on people, or particularly young people. So due to this, it's likely that costs will continue to increase a little for all the legal battles and just trying to increase safety. And what makes it worse is that Mark Zuckerberg said this in a Q3 call. We are retooling our means to make serving young adults their North Star rather than optimizing for the larger number of older people. In business terms, yes, this makes sense because if you track someone and get them on Facebook app at a young age, they may potentially be customers for life, and younger people are more adaptive to change, such as brand preferences or for advertising purposes. But this isn't really a good look either. In this article, it also says that according to Bloomberg, Facebook saw a 16% year-over-year decline in the time teens spent using the platform from 2020 to 2021, and the amount of time young adults, those between 18 and 29 years old, were using the platform, meanwhile fell 5%. On the flip side, people over 30 spent more time on Facebook in the same period. There's also one more survey I want to show you guys here, the Piper Sandler Fall 2021 survey. It was done with 10,000 teens across 44 states that revealed that 35% consider Snapchat their most favorite social media platform, 30% considered TikTok, and 22% of teens liked Instagram the most, and that number continues to fall. This doesn't really concern me as much because they'll still continue to grow in other parts of the world and they'll continue gaining more users. Okay, so finally done with all of that. Now we can actually go into the stock price. So looking at FinViz, guys, by the way, if you guys don't know, definitely check this website out. It's amazing. Tells you a lot of information and helps you sort through many different stocks. And you can see all the different news articles and price targets that everyone gives. So from here, we can see that all of the analysts that updated their price targets, they did lower them, but that's because they had it set so high in the first place. Like most of them had it set to around 500 or like 450 here. But regardless, even with these updates, looking at tip ranks, it has a price target of $408, which is a roughly 30% increase, and it's still a strong buy, which I believe is very achievable in the short to near term. So now looking at the actual chart itself, this is what makes me want to buy it right now rather than later, because it just had a very nice pullback of about 18% here. It hit around 380 and now it's sitting around 316. So this is on TradingView, and we can use moving averages, and these are a very common technical analytical tool to use. So the reason for calculating the moving averages of a stock is to help smooth out the price data over a large and specified period of time by creating a constantly updated average price. And most commonly the 50 and 200-day moving averages are used, but there's also like a 15-day, 20, 30-day, 100-day moving average. But the shorter moving averages are typically used for short-term trading, while the longer-term moving averages are more suited for longer-term trading. So now I'll look at the 200-day moving average, which is this purple line here. And going back to however long you guys want to go back to, notice where the line is. The stock price is almost always above the line, and only in some instances the stock price will be below, or it'll touch the line and then it'll spike back up. So looking at the current stock price right around here, we can see that it broke the 200-day moving average, which is a very good time to create your buy position or increase your holdings. And I still wouldn't dump everything in there just because it can continue falling, and it's always nice to rebuy and lower your average in case that ever happens. And guys, this is not financial advice, so definitely take this with a grain of salt, but it breaking the 200-day moving average is definitely a buy signal for me, and I will be buying. So that's all I have for you guys today. Hope you guys enjoyed it, and don't forget to subscribe to keep up. Peace.